Recently, Blackrock, a leading global investment firm, has agreed to acquire Global Infrastructure Partners, also known as GIP, who is a major player in infrastructure investment, for $12.5 billion. This acquisition is a significant move on BlackRock's part because it emphasizes their focus on infrastructure as a key area for growth and investment opportunity. GIP was established in 2006 and is based in New York. It is the world's largest independent infrastructure manager with over $100 billion of assets under management. The firm specializes in investments across various sectors, including energy, transportation, digital infrastructure, and water and waste management. GIP's portfolio includes significant holdings in sectors like renewables, Clearway, Vina, Atlas, and Eolian, major airports like Gatwick, Edinburgh, and Sydney, and data centers like Cyrus One, and utilities like Suez, and among others. The terms of the transaction involve BlackRock acquiring all of GIP's business and assets. The payment is structured as $3 billion in cash and approximately 12 million shares of BlackRock common stock. Notably, about 30% of the total consideration, all in stock, will be deferred and expected to be issued in approximately 5 years, subject to the satisfaction of certain post-closing events. BlackRock plans to fund the cash consideration through an additional $3 billion of debt. This acquisition is aligned with BlackRock's strategic vision of infrastructure being a major source of investment opportunity, particularly in the context of low carbon transition and global economy's structural shifts. The deal is expected to significantly bolster BlackRock's position in the private markets, with a combined entity managing more than $150 billion in global infrastructure assets. Following this acquisition from BlackRock, GIP's founding partner, chairman, and CEO Bayo Ogunlesi will join the board of BlackRock. Both firms have expressed enthusiasm about the merger, citing the complementary cultures and shared commitment to excellence in client service and investment partnership. So, why is a large firm like BlackRock interested in acquiring GIP? There's three key factors of why. First, the growth in physical and digital infrastructure. Fink pointed out that both physical and digital infrastructure expansion are accelerating, spurred by government prioritization of self-sufficiency, security, and increased domestic industrial capacity. This includes a focus on energy independence and onshoring or nearshoring critical sectors. Next, we have the decarbonization and energy security trends. Infrastructure investments is seen as crucial in the context of low global carbon transition. Policymakers are implementing significant financial incentives for new infrastructure technologies and projects, especially those aligned with sustainable energy and decarbonization. The final reason why BlackRock is interested in GIP is the opportunities in the private markets. BlackRock views infrastructure as a major growth segment in the private markets, so this acquisition of GIP, with its extensive portfolio and expertise in infrastructure, allows BlackRock to significantly expand in that area. So, what are some concerns relating to this acquisition? First, we have market consolidation and competition concerns. One of the key concerns surrounding this acquisition is the potential for decreased competition in the investment sector, with BlackRock already being a significant player in the asset management, including GIP's extensive infrastructure portfolio could further consolidate the market, potentially leading to less competition and increased systematic risk. Next, we have cultural integration challenges. The merger of GIP, a specialized firm, with BlackRock, a much larger entity, presents potential challenges in terms of integrating cultures. Merging these two organizations, each with its own unique operational style and culture, could be a complex process, as it's crucial to maintain GIP's strengths while integrating it with BlackRock's broader framework. a task that requires careful management. Final major concern is the regulatory scrutiny and public perception. As BlackRock grows in size and influence, it may face increased regulatory scrutiny and public expectations, especially in today's financial environment where large finance companies are often viewed with suspicion. So, what are the positive impacts of the acquisition of GIP? First, we have diversification of portfolio. The acquisition diversifies BlackRock's investment portfolio, particularly in the infrastructure sector, which can be appealing to investors looking for a more balanced portfolio. Next is the growth opportunities, especially with the combined entity may have a greater growth opportunity given that GIP's significant presence in infrastructure investments, potentially leading to increased revenue and profitability for BlackRock. Finally, we have the synergy benefits. Operational synergies post-acquisition can lead to cost savings and increased operational efficiency, benefiting the bottom line. What are some opinions circulating about this acquisition? First, from a strategic advantage perspective, some view that the acquisition as a strategic move by BlackRock to diversify into the private infrastructure investments. This sector is increasingly important due to its stable return and potential for growth in the context of a global infrastructure needs and transition to a low carbon economy. Next, we have positive market impact. Analysts have noted that the deal could reshape the investment landscape, particularly in the infrastructure sector. It could set a precedent for future mergers and acquisitions, possibly triggering a wave of similar deals in the industry. In terms of financial performance, from a financial perspective, while the deal is seen as potentially beneficial in the long term, there are a few concerns about the immediate impact of BlackRock's financials, especially considering the costs and risks associated with such a large acquisition. In terms of investor sentiment, investors' reactions to the acquisition is mixed, with some viewing it as a positive development for BlackRock's growth prospects, while others are more cautious, waiting to see how the integration unfolds and its impacts on the company's bottom line. Here's a quote from Larry Fink, the CEO of BlackRock, on what he thinks about this acquisition. Infrastructure is one of the most exciting long-term investment opportunities as a number of structural shifts and reshape the global economy. We believe the expansion of both physical and digital infrastructure will continue to accelerate as governments prioritize self-sufficiency and security through increased domestic industrial capacity, energy independence, and onshoring or nearshoring of critical sectors. Policymakers are only just beginning to implement once-in-a-generation financial incentives for the new infrastructure technologies and projects. This quote reflects BlackRock's view of the strategic importance of infrastructure investment. And here's a quote from GIP's founding partner, Chairman and CEO Bayo Ogunlesi, stated, "Investors have adopted private infrastructure investing for its ability to provide stable cash flows, less correlated returns, and hedge against inflation. Global corporates have turned to private infrastructure as a fast innovator and more commercially agile owner of infrastructure assets that are the core to their commercial businesses. This platform is set to be the preeminent one-stop infrastructure solution provider for global corporates and public sector, mobilizing long-term private capital through long-standing firm relationships." Ogunlesi's statement emphasizes the value of private infrastructure investing and the one potential of combined platform. And finally, we have a perspective about the acquisition from the cryptopolitan. However, it's not all rosy. With size comes scrutiny, and BlackRock's GIP acquisition invites its fair share of skepticism. Critics might argue that such consolidation in investment world could lead to decreased competition and increased systematic risks. This quote highlights some of the concerns relating to the acquisition, particularly the potential for decreased competition and systematic risks.